Good morning. May the 4th be with you. Yes, it's a little cheesy, but us actuaries aren't known for our sense of humor. Anyway, on to the market update for May. Should we sell in May and go away and deep dive into our money market unit trust and some other interesting tidbits that we will get to. But starting off with the retail surveys. So there was a request last month. I've been showing you our institutional surveys that looks at pension funds and compares them across different time periods. Now we're looking at our unit trust surveys, which is, I think, probably more relevant, not only because it's available to everybody and there's a bigger universe, but it's net of all costs, net of everything. Every single possible cost is taken out. The return you see is the money in the bank. And that's very important. And it's what we are continuously saying, that keeping costs low is vital and transparency is vital. And the best way to see that is in the unit trusts. So if you look at our Sygnia skeleton balance 70 fund, you can see there we are 8th out of 86. That's phenomenal performance. So we're very, very proud of that track record. And it really is the fund that meets all possible needs. Yes, I mean, this is not advice, and obviously you need to see exactly what your risk profile is and what your time horizon is. But for someone who, like myself, I have every single cent of my retirement annuity in this fund. And I don't see any reason not to. If you're under the age of 50, so you've got a long time until you're going to retire, and you've got an average to higher risk tolerance, then why not? It gives you maximum global that your retirement annuity allows, gives you exposure to the 4th Industrial Revolution Fund, the Health Innovation Fund, emerging markets. It has the tactical asset allocation, risk overlay, and active risk management. It has everything for an incredibly low fee of 35 basis points. 35 basis points plus that. And that includes your retirement annuity wrapper, your platform fee, the management fee. I mean, it's just incredible. I mean, most competitors will charge 2%, and there'll be hidden fees and performance fees and other things. This is 35 plus that, and you get everything you need for retirement. And it certainly shows when you look at net funds against other net funds. 8th out of 86 since inception. You can see here the chart. That's the red line is the fund performance, and the gray line is the multi-asset high equity category average. It's doing very, very, very well. And there's also, for people with slightly lower risk appetites, there's the skeleton balance 60 fund. This has 60% equity, not 70% equity, slightly less offshore. It's first out of 53 since inception. It's just phenomenal. Passive, low cost with active risk management. That's all you need. And then for people that are closer to retirement or have a lower risk profile, there's the skeleton balanced 40 fund. This is 40% equities. Again, it's got everything. In the global portion, it's still got access to 4th Industrial Revolution and health innovation and those key satellites that we talk about, emerging markets. It's got our risk overlay, and it shows the performance, first out of 73. So if you're looking for an investment and you're worried about fees, I think this is something you should be looking at. Anyway, enough marketing. Let's look at the markets. And it's always good to remind ourselves that stock market is manic depressive. We had the Berkshire Hathaway AGM this past weekend. Always exciting to listen to what they have to say. Charlie Munger said on Bitcoin, "I don't welcome a currency that is so useful to kidnappers and extortionists," which is a fair point. Buffett on SPACs. I'm not sure if you're familiar with SPACs, but they've taken over in the US, where people launch, celebrities are teaming up with people to raise capital without an idea, with the promise that they'll invest that money within 2 years. And Buffett says, SPACs have to spend their money in 2 years. If you put a gun to my head to buy a business in 2 years, I'd buy one. So certainly the old heroes of the markets are worried about the new concepts that are coming through in terms of Bitcoin and SPACs. And Buffett did spend some time comparing the markets to that of 30 years ago, when Japan had 5 of the top 10 stocks in the MSCI world. And he reminds us the world can change in a very, very dramatic way, and that we always need to be on top of where we're investing and managing the risk. He then concluded by adding that the best way to invest is via index funds. And that's certainly what we believe. You want to keep your costs low, but at the same time, you do need active risk management. And that's what the skeleton balance range combines: passive, low cost with active risk management. So reminding that markets aren't completely efficient, and certainly that they can be manic depressive, brings us to our first slide, which is, should you sell in May and go away and come back on St. Leger's Day? So this stems back quite some time, when traders in London in the hot summer months would leave their desks and enjoy the summer, and then return mid-September for the famous horse racing St. Leger Derby. And it stuck, and the saying is with us. And certainly there is some sort of seasonal impact. So if you look at South African stock market over the last 60 years, the chart here on the right, the summer months in the Northern Hemisphere in red, or our wintry months in red, certainly they do underperform relative to the other 6 months. So November to April, the blue bars here, on average, over the last 60 years, you earned 1.8% a month, whereas in the winter months, you earn 1% a month. Now, 1% is certainly a great return. I'd be very happy with 1% return per month, and certainly beats bonds and cash and other asset classes. So I don't necessarily think this means you should be selling. So the short answer is, should you sell in May and go away? No. However, what is important is that it does mean that your risk return balance does shift. And when we are managing the risk in the portfolios, we have to acknowledge that. And we have actually reduced our equity weight slightly. We're now 2% underweight SA equities. It's not a big move. It's a small shift. It's our first step. But we do think that volatility is going to increase over the next 6 months, and that the risk-return relationship is not as exciting or not as simple as it was for the last 6 months. And that's driven by 2 factors, really, being the 2 large growth engines in the world. So up till now, there's been so much concern about the recession and the impact of the lockdowns, that the stimulus has just been free, and a fantastic amount of stimulus, fiscal and monetary, has been pumped into markets. But now that we're getting to a point where, at least in the developed world, the vaccine is under control. We've had over 1.1 billion doses, so it's quite a scary number. 1.1 billion doses have been administered across the world, and that's allowing the developed world and those countries where they have rolled out large numbers of vaccines and doses to start rebalancing securely the stimulus. So the 2 big drivers of the world, China and the US. China is reducing its fiscal stimulus and switching more to allowing the domestic economy to recover. And similarly, the US is, although they're still increasing stimulus, at the same time, they are increasing taxes to pay for that stimulus. So we're getting a much more balanced approach coming through. Money supply, excess money supply, which is a key driver of markets. You can imagine when there's excess money, that money has to end up somewhere, and that is now turning down. Still positive, but it's less positive than it was, and that also tends to have a negative impact on markets, or at least things won't keep on running as fast as they were. So we certainly think that we're in for a volatile 6 months. We do think by the end of the year, the markets will be higher. That is our base case. But for the next while, we are just hedging exposures slightly. So more on just a global look at markets and the impact of all the spending. The US government budget deficit for March was $660 billion, a record high. and it's going to be higher with all the stimulus that Biden is hoping to pass. That's 3 times, that 1 month, it's 3 times South Africa's entire national debt. It's just again, a staggering number. And yes, it is important, and stimulus has helped us get out of the hole that we were in last year. But I've said it before, and I'll repeat it: you can't grow yourself, or debt has to be paid at some point in the future. And so you basically are stealing from the future and bringing it to the past, and there's no free lunch. And what is more concerning is that the more you do this, the more governments focus on fiscal spending and government spending. Government spending is not as efficient as private spending. And the more they do it, the less efficient it becomes. So during the Reagan era, a $1 increase in debt led to an 88-cent increase in GDP. So almost 1 for 1. We're now at the point where in the US, a $1 increase in debt boosts GDP by 35 cents. That's basically 1 for 3. That's not really good. In Japan, every yen of debt adds only 20 cents to GDP. And as you know, they've got the highest debt to GDP in the world. They started QE 23 years ago. They are our poster child for what the developed world is moving towards. So the huge amount of stimulus that we've got is fantastic, and it's needed, and it's helping us avoid a depression. But I don't think that we're going to go into another inflation supercycle or commodity supercycle. I think that the chart on the right is what we're going to is where we are. Growth is going to remain low. Interest rates are going to remain low as a result. When you have low growth, interest rates can't afford to be high. When you've got so much debt, interest rates, the economy just can't handle any more or much higher interest rates. Yes, I mean, if you can see, this is a 700-year chart. It's quite phenomenal. So the dark blue is world GDP, starting at a decent growth rate of 14% in 13-14, and coming down to around 2% in 2020. And the light blue line is the interest rates, and that's pretty much have got down to 0. Now the 0 bound is an obstruction, so I don't think this line is going to continue on a downward trend. We're probably going, definitely in the short term, we can pop up with some cyclical stimulus, and but then I think we will be bouncing around the 0 level for a while. So you might ask, well, if you think that we're in for Japan, and the best asset class in Japan over the last 30 years was bonds, why does Sygnia not have any bonds or gold or Bitcoin or all these risk-off asset classes? And that's because in the short term, we do think that over the next year, this year and possibly mid next year, that growth is going to recover as the vaccine allows markets to open up. I've spoken about value and growth before, but this is a really nice stylized chart to show what we do expect over the next 6 to 12 months. So on the horizontal axis is the US Treasury 10-year bond yield. So currently sitting at about 150, 160. That's 1.6% on US 10-year bonds. And as growth recovers, we will expect that commodities will, the markets will open, GDP will improve, and the recovery will take hold. And as the recovery takes hold, so the interest rates will move up. They're definitely not going to get back to the highs that they were, but we could easily get up to 200, maybe 220. This is from JP Morgan. They're expecting it to be 2.5% by the end of the year. I'm not as bullish, but I think the direction is right. I think that over the next 6 months, as the vaccine allows developed markets to return to the old normal or somewhere towards the old normal, that growth will improve and continue to improve, and interest rates will rise with inflation, because inflation certainly will pick up in the short term. Longer term, there's no growth, but in the short term, it will pick up. And so what does that mean from this chart perspective? Well, the blue line here is the reopening inflation trade. So it's saying, well, as we move back towards the old normal over the next 6 months, the best performers are going to be the stocks that are most hurt. Banks, emerging markets, travel, airlines, and sort. Then the darker blue line here is value, and they're saying, well, because value is very much dependent on interest rates, and the higher that interest rates go, the more value is preferred relative to growth. That value will certainly pick up relative to growth, which is the brown line. S&P is purple, which is just the average. So they are expecting markets to end the year slightly higher. And then hyper growth bubble, that they're talking about cryptocurrencies and other hyper growth stocks where high interest rates will have a severe impact on that, and possibly Tesla could be thrown into that hyper growth bubble horizon. So that's certainly why we are continuing to have exposure to the value ETF in our global portfolio. It is a tactical position. It's not a long-term position. We do think that in a low growth environment, you want to have exposure to your low market share niche growth companies such as Fourth Industrial Revolution, healthcare stocks, things that are more defensive and will continue to grow. But in the short term, when markets are improving and all ships are rising with the tide, well, then it's good to have value. Value's been the best performing ETF this year, and we think that it will continue to run as momentum actually starts to invest in that. So while that's happening, we want to avoid gold, which does poorly when interest rates are rising. We want to avoid global bonds, which obviously do poorly when interest rates are rising. And it's one of the reasons why we don't have Bitcoin. There were a few questions that were asked me to cover Bitcoin this month. So just some other reasons why we don't like Bitcoin. Firstly, value. I mean, I think that it's if you look at the cost of mining Bitcoin, it should be a lot lower. But let's forget value because there's a lot of momentum behind. So let's look at the sustainability of Bitcoin. Firstly, energy usage. Bitcoin mining uses more power than South Africa each year. Maybe South Africa is a bad example because we don't have much power, but still, it's a shocking amount of power. An entire country's worth of power is used to mine Bitcoin. Secondly, speed of transactions. Bitcoin can do 5 transactions per second compared to Visa, which does 20,000. 5 versus 20,000. That's not really efficient. Cost of transaction. I mean, your Visa costs are cents on the rand. A Bitcoin transaction is 500 rand for a transaction. So those are all reasons why it's not going to replace Visa, for example, in the short term. But I think the more concerning thing is that it's Charlie Munger says that it's used for kidnappers and extortionists, but it also allows people to avoid paying tax, and governments don't like that. Governments rely very heavily on tax, solely on tax. Without tax, they don't exist. So you can expect governments to start banning and fighting back. I mean, Turkey was the latest. They banned Bitcoin, and certainly when it comes to worrying about money laundering, not paying tax, certainly Bitcoin's not ESG friendly with its power usage. There are a lot of reasons why governments can ban it. Now, the reason that, or if you want to be cynical, the reason why stock markets have done so well over the last 30 years is that whenever there's a problem, we have the Fed put and the Fed lowers interest rates. The Fed kind of protects markets because they know that that's important to economies. The Fed and central banks have no reason whatsoever to support Bitcoin. If Bitcoin collapses, they're not going to go, oh, let's lower interest rates and try and protect that bubble. So you want to be in an asset class that you've got the government that's backing you to some extent. Anyway, a lot of different reasons, but even if we did like it right now, we don't hold gold, we don't hold dollar bonds. We think that this is probably a good stylized view for what's going to happen over the next 6 months. Yes, there'll be volatility. It's not going to be a straight line, but that's our view on markets. Longer term, though, we do believe that you want to be exposed to your thematic growth sectors, and we do think interest rates will stay low. So I mentioned the two powerhouses of global growth, America and China, and the rebalancing that's happening there. So I will talk about those two briefly in a bit more detail. So Biden, hot on the heels of announcing his Better Build Back, his American jobs plan, his $2.2 trillion infrastructure plan. He's now announced a $1.8 trillion welfare plan or American families plan or American rescue plan. It's funny how these plans have so many different names, but it's just basically this is stimulus 3.0 from the Biden office, and it looks fantastic. However, he's not going to fund it through debt. He wants to fund it through tax. So we're getting to a point now where Biden's policies, although we had an incredibly strong first 100 days under Biden, and markets have done better than in the first 100 days under any US president. But now we're getting to a point where they're starting to look a bit more balanced. I mean, his $2.25 trillion infrastructure stimulus plan is fully paid for by raising income taxes and corporate taxes. And if you just look at that impact next year, 2022 earnings in the US are actually now being downgraded relative to what they were. They're still up in absolute terms, but they're being downgraded because the impact on taxes is higher than the support from infrastructure. And the social spending plan, 1.8 trillion, is almost fully paid for by doubling the capital gains tax. So this is a big inequality pay. The wealthy individuals are subsidizing the social spending to reduce the inequality gap within the US. And yes, it hasn't been approved and will probably get approved in a watered down version, if at all. But the point is that we're not talking about not taking on any more debt. We're talking about, at least we're talking about trying to fund some of that debt over the medium term with higher taxes. So the chart on the right shows that, yes, relative to history, maybe, like you go back to World War II, taxes have been slightly higher, but capital gains tax certainly is nearly at its all-time high. And corporate tax is still relatively too low, but again, individual tax rate here in the gray is back at the highs of the last 20 years. And that's certainly going to have an impact on growth in the US and an impact on the stock market. We're also seeing an increase in regulation. There's a renewed bout of antitrust lawsuits against Apple and Google, to name a few, and also an increased awareness and focus on ESG by the Biden administration, all of which are going to create winners and losers within the US, and as a whole are going to provide headwinds to the US market. I think it's good for the US economy. It's definitely good for the US population. It's good for the rest of the world, but it's going to provide a bit of a headwind to US markets. So that's why we underweight the US economy in terms of MSCI world allocation. So the MSCI world is what, 2/3 US, and we are underweight that. And why it's good for the rest of the world is because the Fed has come out to say that despite the fact that inflation is likely to peak over the next year, it's transitory. It's not going to have a permanent impact. We do agree with that. And as a result, they're not going to raise rates, which will allow real yields to be low. And when real yields are low, it means that it's more attractive for investors to buy bonds elsewhere. And so the dollar is probably going to stay weak, which is very good for commodities, very good for emerging markets, really, really good for the rest of the world growth because your funding currency is cheap. So certainly the US story has gone from fantastic to balanced. And within that, there's a nuance between sectors within the US. And it seems to be more beneficial for the rest of the world than it is for the US. And that's certainly not what Biden intended, but to reflate his economy and keeping the dollar weak, that's the unintended consequences. It's good for us. The other big driver of growth is China. And China has to remain the cornerstone of any emerging market portfolio. And there are three reasons why emerging markets did poorly over the last decade. One is the tech allocation was lower than the US. The US certainly had more tech within its equity market. The second was a strong dollar, which was a headwind to the rest of the world. And the third was lack of reforms. And China is really moving quickly forward on that reform basis. And they're trying to stamp out corruption. So we have here a photo of Lai, the former chairman of one of China's largest SOE, and he was accused of taking bribes to the tune of $277 million. He was accused, he was found guilty, and he was executed 3 weeks later. Now, I'm certainly not a fan of the death penalty, but you've got to understand that is a very strong signal. you know, when people start getting executed within 3 weeks, that corruption is not going to be tolerated, and certainly people will think twice about doing what's not best, what in the best interests of their country. So, I mean, along with that, the 14th Chinese 5-year plan, I spoke about it in detail last month, but they're focusing heavily on tech. They want China to be the next Silicon Valley. They are enhancing intellectual rights to protections. They want to create a market-orientated business environment. They're trying to open up their economy. So reforms are very strong. They're focusing on tech, and they're busy cleaning up their current tech companies. I mean, Alibaba was fined $2.8 billion for being anti-monopolistic, and they imposed wide-ranging restrictions on financial divisions of 13 companies. So where you have a big tech company like Alibaba and Tencent, and they've got what the regulator's calling a financial division where they're transacting, they're clamping down on those transactions. So that impacted Tencent and ByteDance, and certainly Naspers' share price has been a bit weaker over the last month. Tencent was also fined, but China's doing its best to clean up that sector so that they can promote long-term growth. So certainly, I mean, the three headwinds: lower tech, a strong dollar, and domestic reform. China is working really hard on the tech side and on the reform side. The dollar, as I've said, is likely to remain weak, not because of China, but because of what the US is doing. And Chinese growth just remains incredibly strong. Their retail sales beat expectations, coming at 34.2%. And what that means is that China can afford to have slightly lower growth going forward. So the total social financing in March came off slightly, and it means that what it means is China's prepared to accept or can afford to accept slightly lower growth going forward over the next 6 months to focus on growth in the right sectors. So they'll be focusing on growth within the new economy sectors and allowing the overall economy to slow. So what that means is, if you look at this chart here on the right, the dotted green line is the Chinese leading indicator, and the black line is Chinese imports, and that's primarily resources. So you can see here really strong imports: iron ore to support steel production, oil, all doing really well. Whereas the lead indicator is actually slowing down. So Chinese economy we expect to slow in the second half of the year. It doesn't mean the new economy is going to slow, but certainly when they rotate away from infrastructure to new economy, the imports are going to slow, and so we expect this black line to follow the green line, which means that commodities as a whole are going to slow. So we are concerned that resources will weaken over the next 6 months, which is likely going to lead to a weaker rand and overall slow down within the resource sector. We do think that it still means strong growth within emerging markets and China in particular, but I don't think that we're going to see a resource super cycle or commodity super cycle happen this year. We remain overweight emerging markets. We've also bought a direct exposure in China. We have submitted our Chinese unit trust FSCA, and we are also have submitted to the JSE our Chinese ETF. So we're looking to launch that hopefully in the later half of this year. But we are still very bullish on emerging markets and China. So then we come to South Africa, which is always, I unfortunately have to sigh before I have to talk any further. Tito here says growth prospects are significantly hampered by ongoing energy constraints. And as usual, he's spot on. And as usual, South Africa knows exactly what is the right thing to do and what is the right thing to say. We're just not really good at execution. For example, the latest Ratings Africa Municipal Financial Sustainability Index, MFSI, shows that municipalities have been collecting 18 Rand for every 100 Rand invoiced. So if you're a mug like me and you are paying your rates and taxes, apparently we're in the minority by a long way. And that's a big problem. Municipalities are now massively underfunded. Not only that, but they can't afford to pay Eskom, and that has spiraling impacts. So yes, South Africa, we're doing quite well. The rand is strong, and because of the weak dollar and because of global stimulus, which is supposed to push up commodities. But as I've said, I think that's going to taper off over the next 6 months, certainly by the end of the year. And then we'll be focused purely on what South Africa is doing. And we are behind in two things. Along with other emerging markets, we're behind in our vaccine rollout. So as of the 3rd of May, we had administered 318,000 doses, about 0.4% of the population. That compares to North America, you can see here, which is close to 30% of the population, Europe, which is close to 25%, South America, which is at 10%, the world, an average of 6%, and Africa as a whole, down here around 1%, and we're even lower than that, at 0.4%. So we've been lucky, we haven't had a third wave, and hopefully let us pray that we do not have one. But it's certainly one of the headwinds that is facing emerging markets, ex-China, and is one of the reasons why we did buy a bit of China as well as emerging markets, because it is going to be the stronger part of that. We're launching our emerging market 50 ETF soon. I'll have more details on that later. That's got more than 50% exposed to China, so that has a really nice allocation to China, which is great. But within South Africa, we're just not doing what needs to happen in terms of reforms. ANC Secretary General Ace deadline to step aside has passed and nothing's happened. There's breaking news today that Cyril may have support to push Ace out, and we'll be watching that very closely. But now, even more concerning, there's allegations of corruption that have emerged over the risk mitigation independent power producer program, with Gwede Mantashe's wife a possible beneficiary of the car power ship tender. So last month, if you'll remember me saying that it just looks strange. We were wondering why this had happened. I mean, why for an emergency power producer a stopgap do you sign a 20-year agreement? It just sounds strange. Why do you choose 2/3 of that emergency power to go to one provider? There were 8 or 9 projects that are awarded. 2/3 of that went to car power, and none of those are all ships sitting offshore. So it doesn't create jobs, and it's dirty. So it didn't quite make sense. So there might, we'll have to see where these allegations go. There might be nothing in it, but certainly it did sound strange that 2/3 went to car power ship. What's worse, and this is what disappoints me, is that rightly or wrongly, we're now in a point where the tender process has been put on hold. So our growth is reliant on power. We cannot grow without electricity. We have an emergency mitigation power program that's supposed to stop load shedding and get us through the next 2 years until we're back on track. This is now on hold pending investigation. So the entire country is suffering because of potential allegations. Now, rightly or wrongly, China has a much stronger view on that, and maybe we wouldn't be sitting in this position if something was as severe as that. But we are where we are. We still underweight South African equities, because until there's a stronger focus on tech within South Africa, until there's clarity on reforms, until there's a better rollout of vaccines, that is a concern. Yes, South African equities actually have done very well over the last 6 months, and us being underweight has hurt. It's been one of the better performing indices. That's been solely driven by resources, which have really doubled the rest of the stock market. But again, I think that's going to normalize towards the second half of this year. So unless we see strong reforms coming through, we're happy to keep our underweight in South African equities. So how do we put this all together when it comes to positioning? As I said, we are worried about the overall rebalancing of stimulus coming out of China and the US. And so as a whole, we're underweight equities. We're balancing that by being overweight South African bonds. We don't have any global bonds or any gold, which is a global asset, or any Bitcoin. So sure, I see a question from you. Your hand is up. send me a message if there's something urgent, sure. So carrying on with the outlook, we have so as a whole, in terms of our passive core, underweight South African equities, overweight South African bonds, overweight global equity, and underweight global bonds. Then within our satellites, we still have big exposures to value, which is not on this because it's a tactical satellite. Our specialist real estate position, which has strong value leanings. We still love the tech sector, fourth industrial revolution, and FANG, although in the short term, we have a very, very small overweight to that because we do think that will underperform. We've got a large overweight to emerging markets, and we've just added China. We're very excited to announce the launch of our emerging market 50 ETF on the 14th of May. So put that in your diaries, 10 days time, 14th of May, and we'll be launching that ETF. It looks like it is the cheapest emerging market ETF in the market. It's certainly incredibly liquid. It's got the highest allocation to China. We're very excited about it, and that's great. Our healthcare ETF is still on track for end of July, early August, and then towards the end of the year, our China and our crypto and our autonomous tech climate change ETFs should come to the market. Still got a nice big overweight to health innovation, and we think that healthcare is a structural tailwinds, and that certainly has improved. That's picked up nicely as performance. It was struggling at the beginning of the year, but that's picked up nicely. And then locally, we have unlisted credit and infrastructure. Our first investment into the infrastructure market has been delayed because National Treasury is still debating the definitions of infrastructure, which is important. We want to make sure that we all agree on what infrastructure is before we move into that space. But we are ready and excited to invest in that first bond when we have the opportunity. And one last slide before I move on to questions. The Sygnia money market fund is still available. The unit trust on the retail side is still available at 0 fee. So what we wanted to do here in this chart is just show this is the peers, the unit trust peers with 2-year performance ranked. You can see here that here the Sygnia money market fund very much middle of the pack. But because the returns are so clustered, you remove that fee, and all of a sudden we jump close to top of the pack. It's incredible what a big impact that has in terms of your relative performance when you can save as little as your fee off the money market unit trust. And I'd just like to go a little bit more into the unit trust. There were some questions about what it looks like. It is very well diversified. So we have no intention of trying to be the best performing money market unit trust. We don't intend to be number one. We're very happy to be in the middle of the pack. The point of the unit trust is to be low risk and well diversified. So we are comfortable with a middle of the pack performance. As you can see, the performance is really tightly clustered. So you're giving up 10 or 15 basis points of performance to have a much lower risk. And that's how we've designed this fund, and that's what we're comfortable with. So it's very well diversified. It's got 32 issuers. So credit, I mean, the best way to reduce risk in credit is to diversify. We have a great credit team, 6 people, over 100 years combined experience that are analyzing that portfolio every day. Every investment that goes into it and comes out of it, the team looks at. We've got no convertibles, no exotic instruments. 80% of the fund is in government. So that's treasury bills, very low risk, and big bank paper. So again, a very low risk, a big chunk to your low risk asset classes, government and big banks. And then 20% is very well diversified across the blue chip corporates. So we've got small allocations to Mercedes, to MTN, to Woolworths, to ASI. The companies that are household names that have got lots of triggers to pull if they are ever in any headwinds. They can firstly cut dividends, then they can do a rights issue. There are lots of things that can happen before they even think about restructuring their debt. All very high credit ratings, and so we believe that the fund is well-performing, well-diversified portfolio. And the fact that the fees are zero means the performance relative to our peers actually bumps up just by the fact that there's a high yield and you're not paying those fees. So certainly that zero fee is in place until the end of 2022 for people who get in now. You do have to get in soon. So please, if you are looking to invest, invest soon. And yeah, I think it's a great place to park your cash. Certainly relative to a bank account, you earn a nice yield enhancement and you retain good liquidity. So that's it for today in terms of the presentation. Let's look at some questions. So a question on the money market fund. Thank you, Christian Wessels. The current yield, so by regulation, you have to put the 12-month historic yield on the fact sheet, which doesn't make sense because you know, the yield that you earn on a money market depends very much on what interest rates are doing. If interest rates go up, you earn more. If interest rates go down, you earn less. So currently, where interest rates are at the moment, the yield on the money market fund is 4.2%. So if you invest in that fund now, you can expect to get 4.2%. If interest rates go up over the next 6 months, well, then it'll be slightly higher in terms of 12-month return. If they get cut, it'll be slightly lower, but we're not expecting a cut. In fact, we are expecting one hike within 6 months' time. So probably maybe a little bit longer. First quarter of next year. So the move is up. So we think that 4.2% yield is probably going to go up slightly over the next 12 months. Question on the closure, Dominic White, the closure of the Absa Money Market Fund. Seems like there's more to the story. Yes, I'd have to agree to you. I don't know what the story is, but there are multiple reasons that have been given, all of which I don't understand. Maybe I'm just stupid, but I don't understand the reasoning. Brian says Sygnia is great. Thank you, Brian. Question on the Rand by Peter Newman. So we have been bullish the Rand for the last year, pretty much, maybe 9 months, because once commodity prices start to bounce and South Africa being a commodity exporter, and because the huge amount of global and fiscal stimulus, we knew that the Rand, South Africa being a small open economy, the Rand, despite what South Africa did, would do well. We're now getting to a turning point where it isn't as clear. At the moment, we're still on the tailwinds. Commodity prices are still high, and there's still tons of stimulus. But I think towards the end of the year, as commodity prices come off and the stimulus starts to taper, we are going to see headwinds to the Rand. So I think that the Rand, is probably stay range bound for the next 6 months, but towards the end of the year, we do think it might hit 15 or 15.50, certainly to the weaker side than we are now. So now is a great opportunity, we believe, and we are overweight global. We think now is a great opportunity to take money offshore. Yes, in the short term, the Rand could hit 14 again, but I think by the end of the year, it'll be weaker. John asks about living annuities and our offshore exposure. We are actually about to launch an exciting income fund in the living annuity space, so you'll hear more about that soon. And we also should have an update relatively soon on which we're about opening up some funds on that. Not all of the funds, but certainly there will be more clarity on that soon. So please watch that space, and hopefully we'll send us them shortly on the living annuity caps. So James Shepherd asked a question about gold and high inflation. So in the short, okay, well, gold is a proxy for inflation in the very, very, very long term. In the short term, gold is a proxy for bonds, global bonds. So if you're worried about equities, and you're worried about, you don't want to take risk, you can put your bonds, your money either in bonds or in gold. When yields are high, you prefer bonds because you earn a yield. And when yields are low or negative, you prefer gold because at least you're not paying away anything. You're not paying negative yield on your bonds. So they are basically proxies for each other. So in the short term, when we do think inflation is going to pick up, global bonds will do poorly and gold will do poorly. In the long term, if we thought inflation was going to be with us for the long term, then it might be worth buying gold. But I think in the long term, I'm still more, and it's a big debate right now. But I'm definitely in the Japanification roadmap, aging demographics, excess debt, shrinking labor force. They're all headwinds to inflation. Globalization hasn't gone away, and that means that certainly in emerging markets might have inflation, but I don't think we're going to see inflation in the developed markets long term. Short term, yes. The US is basically, they've now given 3 checks to every US citizen. They just pumped cash into bank accounts. Short term, there's going to be some nice inflation, but the Fed is looking through that, and I think that markets will look through that as well. Barbara Hardy says, should I sell resources? Again, timing is very difficult. Right now, there's still some tailwinds to resources. I don't know when when it's going to turn. You know what they say about people who pick market tops and people who pick bottoms. They get smelly fingers. So I'm certainly not picking the top or the bottom, but I do think towards the end of the year that resources will turn down. So maybe, and the way we like to do it is we do small tranches. We just take, as we have done with our underweight SA equities, we've got a very small underweight. If we see the market has actually peaked, then we'll make that slightly larger and slightly larger. But we like to do things in small tranches because it's impossible to predict turning points consistently anyway. You can get lucky, but so another question by Kubus on the Sygnia emerging market ETF. So ours is the emerging market 50 ETF. So it focuses on the large caps, which means it's more liquid, which means that your bid offer spread is lower. So it's much cheaper to get in and out of. Also means the costs can be lower to run it. So it's lower expenses, lower bid offer exposure. And because it's the large caps, it has indirectly, it has a large exposure to China. So I think the MSCI EM index as a whole has probably got 45% exposure to China, and ours has got slightly over 50%, so slightly bigger exposure to China, and also then a bigger exposure to Asia, because those are larger caps, and almost no exposure to South Africa. Very good question by Bella on skeleton balanced when it comes to fees. So I said that skeleton balance is awesome because we invest in our other funds. Some are not ours, but some are ours. But you don't pay double fees. You pay 35 basis points plus the VAT. You don't pay management fees on the underlying ETFs. We cover that out of the 35 basis points. So great question. Leighton has a question on SLS property. I think it's important to understand what you want to do with SA property, or property in general. So as I said, the best asset class in Japan over the last 50 years was bonds. Japanese bonds gave a phenomenal return, phenomenal capital return, interest rates were falling, and their equities gave no return, and you just earned dividends. So in that case, equities was an income asset class, and bonds was a capital asset class. It's a bit strange. But South Africa has been very fortunate in that the 10 years up to 2 years ago, property beat equities. So everyone thought property was a capital gains asset class, but it's not. Property is an income asset class. So when you're looking at income assets, then property possibly you can have an exposure to it. So we've got a very small exposure in our income fund. We've got and our enhanced income fund. We've got 3% exposure to it. We are underweight, but we have some exposure. We may be looking to increase that to 5% at some point. But when it comes to asset classes as a whole, and certainly when capital growth is considered, we have no property. We don't think that you should see property as an equivalent to equities. It might have equity volatility, but it's not. It shouldn't behave like equities. It's not a growth asset class. It's an income asset class. And that is, sorry, that's all questions from the beginning. Let me jump to the end. Renier has a question on derivatives. Yes, we do use derivatives within the skeleton funds. So when it comes to risk management, the most important caveat is keeping costs low. If you had to sell all your equities, or even if you suddenly say sell Anglo American, it's a big company, it's listed, it's liquid. Your round trip cost of, if you had to sell Anglos and then tomorrow you decided that you were wrong and you wanted to buy Anglos back because whatever reason changed, you would lose 1% at least round trip on that. If you use futures, if you put protection on today and tomorrow the politician comes up and says they're cutting interest rates or they're putting on more stimulus, and you think, oh goodness, we're now back on risk on, let's cut back on that protection. You can, if you get in at the right time, you can get out at almost no cost, like less than 1 basis point. So it's very important to have low cost instruments when you are using, when you have got tactical active asset allocation and risk management. And so we do make sure that where we can, we use those instruments. They're all listed and there's no credit risk attached to it. And they are highly liquid and low cost instruments. What's happening with fourth industrial revolution performance? Fourth IR is still up nicely. It's up 16%. Oh, sorry, that's in dollars. In dollars, it's up 16% year to date. So it's had a good year. It's off from its peak because of interest rates rising. It recovered slightly, and we do think that it will end the year higher. But there's going to be a lot of volatility coming in. And when interest rates, US 10-year treasuries rise, it will face some headwinds, and vice versa. So we are seeing that as a long-term play. As I said, we've only got a small allocation in our satellite exposure. And we do think that there'll be better entry points as a whole. But again, that's timing. Timing can be wrong. It's always, and that's why we do have some exposure, because you don't want to be completely out of it. So it's always good to hedge your bets. Again, another question on that here. So while we do think that there'll be positive returns on an absolute basis from FANG and fourth IR, we think they're better global places to be, or at least be diversified. Make sure you've got some emerging markets. Make sure you've got a core, an MSCI, no, so it's actually S&P 1200 Global ESG ETF, so you can diversify those satellite returns. And the only fund that falls into this specialist real estate category is our ETF, the Sygnia Itrix Global Real Estate ETF. SIGP, have a look at that. It's also doing quite nicely this year. Skeleton balanced 70 is a Regulation 28 fund, is allowed for retirement annuities. As I said, it's where I've got 100% of my retirement annuity. I think it's a great place to invest. So there's another question on local property. So property does make up a portion of the ALSI, so SWIX and CAPSWIX. So when you track an index, you do by default have some exposure, but it's very small. It's less than 3%. In terms of the SARB directive and increasing offshore, we haven't heard any feedback about that. Silver is somewhere between gold and copper. It's partly precious, partly commodity. Question by Christopher on electric vehicles, and won't the continued move to electric vehicles consume ever increasing amounts of copper and other metals? So potentially. I've got a little bugbear when it comes to electric vehicles. I'm sure you've all seen the latest news with the Toyota City in Japan that's run off hydrogen. So it doesn't, if you have an electric vehicle, it doesn't mean you necessarily are going to be powering that with electric batteries, or so we say metal batteries. They're still in the running are hydrogen batteries. It hasn't gone away. Who knows? That'd be very positive for platinum. Batteries as a whole, positive for lithium. the battery technology is changing so fast that there's actually a new listing on the Nasdaq that I can't remember the exact, I can't remember the name, but it's now worth $15 billion. They claim to have a new way of making batteries. The technology is changing so fast that you've got to be very careful you don't back the wrong producer. And copper may benefit, but it may not, depending on what that metal is. Certainly, lithium is more important in other metals than copper, but copper would do well. But anyway, back to my bugbear. So I'd love to step on my soapbox a bit and talk about this. And there's a very strong focus on ESG. I mean, that is great, and I'm very excited about that. If you look at, and we've delved into ESG indices. So there are a lot, but pure ESG, not like the one we've got, which is S&P Global 1200, which has got tilts. If you look at the ones that focus their revenue share on companies that are involved in climate change and the like, they all tend to be quite similar. Whether you look at MSCI or S&P or Sol Active or FTSE, all very similar, and they all have 15% to Tesla. And they all seem to say that the answer to solving the global climate change is electric vehicles. And I completely disagree. It's part of the answer, but for now, a lot of people are still charging their electric vehicles with coal. At home, they're plugging in, but their power is coming from coal or LNG or other dirty things. The pollution from batteries is just horrific. You can't recycle batteries. The fact that you're encouraging people to get rid of their old cars and buy new cars is also incredibly bad for the environment. There are much easier ways to improve the world than by buying an electric vehicle. The food production is massive. Look at better ways of sustaining food production that use less water. Cows produce way more emissions than cars do. So why aren't we focusing on becoming, eating red meat less, more vegetarian meals? That costs nothing. You don't have to buy batteries. You don't have to throw away your car and spend a fortune on a new car. You don't have to change the infrastructure of the planet. You just eat a little bit red meat, a little bit less red meat. But that somehow is not seen as sexy, and certainly it doesn't make up 15% of your biggest holding in the ESG funds. So I think that we're going to hit a point where there's a bit more awareness comes through to ESG, and people start going, actually, hold on, maybe just because you are producing an electric vehicle, it doesn't mean that you are ESG. In fact, we've put Tesla through our ESG score. When you look at it as a whole, they're not great. I mean, we wouldn't exclude them. They're not right at the bottom, but they're bottom half. So, I think that, sorry, to step off my soapbox, I think that there's a lot of greenwashing. I think that there's a lot of misunderstanding when it comes to ESG. And I think that right now there's a massive what do I say? There's a massive, not well thought through amounts of cash being thrown at ESG indices when they don't understand what those indices entail. So yeah, we put a lot of effort into the ESG index that we have chosen. It is very well diversified and doesn't suffer from the shortcomings that I've spoken about. But I think that that there are other pillars to the ESG investment world besides Tesla, and that those indices should start being more diversified. With that, Signal Hill has just given me the big bang to say that we're hit 12 o'clock. So thank you very much for tuning in. Thank you very much for listening. Thank you for those who stayed for the last 5 minutes while I was on my soapbox. I'm sorry if that got off topic, but yeah, I do think that ESG sector is looking a little bit hot, and that people could lose money in the short term if they're not careful. So just be wary of what your ESG fund holds, and make sure it doesn't have 15% Tesla. And that's it. Have a great May. May the 4th be with you, and I will see you in June.